But one of the things that I thought was very, I think, incredulous is the right term, is that in some of these newsletters that syndicators sent to their investors, they were trying to explain to investors, why there's a problem, why we may lose some money, what went wrong. There was never any admission of guilt or we messed up. We didn't make an assumption for this. We should have taken a longer term interest rate cap.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. We're back with our guest today, Irwin Boris. I hope you listened to yesterday's segment, but we are going to continue the conversation, but dive into, where do investors go wrong? And what's going wrong right now, and a number of things that you should consider as a passive investor or limited partner before you make that investment, before you send your money to put in that deal. There's a number of questions that he highlights today that are going to help you to be better prepared. Or let's say you've already put the money in that deal, but man, you got that call where it's going sideways, right? There's something happening. He's going to help you through that as well. You're going to learn a lot from Irwin today. Irwin, I'm grateful to have you back for another segment and us diving in and just gleaning from your experience and knowledge in the industry, and really diving in today on where investors are going wrong in a number of aspects. And so I'm grateful again for your time. Welcome back.
No, my pleasure. Thank you for having me again, Whitney. Thank you.
Yeah. Well, let's jump right back in. And actually, I want to remind the listeners first to go and listen to yesterday's segment. If you didn't, Irwin just brought a ton of experience and knowledge yesterday to how they're doing due diligence and how they're being conservative and the deals they're looking at and why, and even got into some reserves and the importance of reserves. So again, Irwin, let's dive right back in here and, let's jump into, where investors are going wrong right now. What are you seeing, as you're reviewing lots of deals and hearing from other operators and investors and the whole industry?
No, sure. If you think about the long run that's just ended on most of the asset classes, especially apartments, coming out of 2010 through 2021, maybe very early, maybe some part of 22, it was really hard to mess up an apartment deal. You really had to try really hard. All the leaky boats came off the bottom of the ocean. And then when insurance started moving and interest rates moving and prices started getting, sometimes you couldn't bail them out. And so people had to become, syndicators and underwriters became a little more creative in how the deals were presented. And as the prices continued to escalate, they would short the growth on operating expenses or shorten the term of the interest rate cap the lender required them to take. And then with renovation costs increasing, sometimes there wasn't enough money to renovate units and they had to cannibalize units to keep them full. But one of the things that I thought was very, I think, incredulous is the right term, is that in some of these newsletters that syndicators sent to their investors, they were trying to explain to investors, why there's a problem, why we may lose some money, what went wrong. There was never any admission of guilt or we messed up. We didn't make an assumption for this. We should have taken a longer term interest rate cap. There's always putting it off. And so, and here are some of the main reasons that I've come across. Either it was bad property management. Lesser experienced syndicators hire inexperienced property managers. And then they say we had to fire them because they weren't doing the right job. And if they change the property manager, sometimes the numbers to improve a little bit. But, the bigger issue right now is that the property was poorly managed and the occupancy is low and may need additional capital beyond the current reserves. Also contractor disputes. People who haven't negotiated a lot of contracts, whether it's, guaranteed maximums or things like that to renovate units, found that their costs escalated a lot beyond their control. And then there was also the timing difference between getting the lender to disperse, getting a lien waiver, and not having the capital to lay out. So then the vendor/contractor went to another property and you couldn't get him back because you couldn't pay him fast enough. It's all a little bit of a breakdown. Or they'd say that the contractor provided extremely poor quality with the renovations, making them need to renovate them additionally before they could rent them. Yeah, stuff like that really shouldn't happen. And then they say that, well, it was impacted by Federal Reserve didn't need to increase rates, and they did, and that caused us to have a debt service shortfall because the interest rate on our loan went up. If they took a full-term interest rate cap, that wouldn't have happened. And then, in addition to things that, where they can't, insurance is insurance. So we've seen a lot of things that they've blamed on other people. And the most interesting thing is a lot of these syndicators are out raising money for new investments. And if you want to find out something about your syndicator, put their name into the search bar, Google, look for troubled loans, look for interest rate exposure, look for defaulted loans. You'll find them there. They're not going to volunteer the information. And a syndicator should tell you about their bad investments, and especially if you ask them directly.
Yeah, asking them directly about their bad investments. I love that. Just get right to it, right? Like, tell me about what's going wrong. Any other specific questions, and maybe there's other questions we'll get into that LPs should be asking, but specifically around, say, the bad deals that they've done or had, or what would be some good questions for an LP to dive into there a little bit with a sponsor?
I think you should ask them about cost overruns on some of their renovations. How do they manage those? How do they manage interest rate risk? You might want to find out if there's an alignment of interest. Do they also own the property management company? Do they own the contracting services? That's the vendor that's doing the renovations. You want to find out, how closely they had to control these things. What's their experience with some of the vendors? I'd also ask for references, not only from other investors, but maybe some industry contacts. Talk to some of their lenders. But I think you really find out a lot about people's character when you ask them about bad deals. First I put them into the search bar at Google and find was even some of the big names are there. Because then if they don't tell you we don't have any, they're lying, and that should be a red flag. Another thing is, if they're not giving you access to all the due diligence on the property, you should have access to everything that they have access to, whether it's engineering, environmental, an appraisal, a survey. Not that you know what you're looking at, but you should have access to it. And of course, you should have access to a working Excel model. And the reason for that is that you might want to stress test it. You might want to see what happens if we spend all this money and rents don't go up 8%, they only go up 3.5%. What does my investment look like? Because syndicators and sponsors, a lot of them make their money based on the promote. So if they think that the longer they hold it, there's going to be no promote for them, they're going to short the investment in order to boost their return. And it could be at the investor's expense. One thing you should also look at as an investor is what kind of cash flow distribution you could expect on a regular basis. Given where interest rates are and cap rates are, I can't see multifamily distributing anything current unless they're assuming debt that's at a below market rate, which there are opportunities out there, or B, they've built in some excess money into the capitalization to pay current, or the business plan, maybe they have the current sponsor just ran out of money. He's got a container with kitchens and bathrooms, and he doesn't have the funds to install them, and you're getting that inventory. And so you can sort of project that, all right, in 12 months, you'll have 50% renovated because the materials are there. It's just a matter of labor. But I think more importantly, you should dial back your expectations on whatever the projected IRR or equity multiple is, and maybe place as much weight on the ability for an investment to generate current cash flow. Because in a worst case scenario, if you're getting 7, 8, 9, 10% a year, and it was 10 years, you basically almost got your money back, and you beat the treasury or the bank account, and you got your principal back plus your tax benefits, that would be okay too.
Speak to Irwin, say the newer, say LP, right, or somebody that's just learning about our industry, and they want to invest, through the syndication model into project commercial real estate through operators like us. They get an Excel model. It's kind of hard to know where to start if you haven't had some training or something. You haven't listened to a number of podcasts, or something. It's like hard to know where to start. Maybe give them just a few key things that of a starting point to. So they can figure out, hey, is this realistic or not? I love what you even just said about some of the cash flow and things like that you should expect. But where are they going to see that? What are some places maybe in the model that they should even go to at a very beginner level to figure out, okay, this is something I should look further into?
No, sure. Some of these models, they should have an assumptions tab, which will tell you what they're growing rents at, what they're growing expenses at. They should also have historical operating expenses, so you know what the current insurance cost is. On that, that will fluctuate market to market and year to year, depending on what the carriers want to do with their losses that they're trying to recoup for. But it'll give you, if you have enough history on the asset, you can see where rents come from and where they've gotten to. And then, there are so many services, that free services where you can go on, apartments.com and just look at what asking rents are. So, if the rent in the model, the renovated rent for a 2-bedroom apartment is the same as everybody else is charging, or is it a lot higher? So it's apartments.com, rent.com, all those free websites. You pretend you're renting an apartment and really take a look at what the apartments look like on the inside. And all these, sponsors have, before and after pictures in their offerings of what the apartments look like today. Take a look at them. You can also map them with you go into Google Maps, see how far some of the other properties are on rent.com compared to the subject property, and just see, are you in the same market? So you can sort of get comfortable with what the market expenses, the income is. Expenses are a lot harder, and that's why you really got to hopefully get some historical operating expenses. I love when, and I hear this from some of my lender friends all the time, that they get these deals in where mortgage brokers are projecting that operating expenses are going to go down 20% under new management. It doesn't happen. That's a whole other reason.
Have a really good game plan on how that's going to happen, right?
Well, I won't. That's another party I won't get into involved. But there are certain people that have been banned from doing business with the agencies right now because of things like that. So you really want to look at what the historical operating expenses are, and assume that they're going to grow at 3 or 4% a year, not at 1.5% a year. Especially taxes. Taxes are going to get reassessed on a sale, if not in the first year, then definitely by the second or the third year. So let's just see if they've taken that into account. You might see a big jump in real estate taxes, which would be the right way to underwrite. And you also want to make sure there's a big margin for error. It's like, ask the question, how many times is the deal, and you could look online also and see how many times the deal is traded in the last few years. And ask the sponsor, how many times has the property been renovated over the last 15 years? He knows. He absolutely knows because that should be part of his due diligence. So sometimes you are lucky enough to find a building where it's 50% original units, and sometimes the 50% are newly renovated and 50% were done by prior owners in different iterations of the renovation. And then you have to say, well, all right, I can understand the original units getting the bump, but I can't see spending any money on the old ones because it's about keeping the building full. And so you have to have a lot of units at different finishes at different price points. It's about heads on beds. You want occupancy. Occupancy will bring income where turnover costs you income. So I think that if you're new to investing, I would look for something that's more net leased, triple net lease, where you don't have the operating expenses, something where you could say, okay, here are the contractual rents, here's the tenants that's in there. The tenant, most of the operating expenses are paid by the tenant. I'm going to get whatever the cash flow is here. Okay. And if that's all I get, are you happy? See, we look at every investment as if we have to own it in perpetuity. Do we like the bones, the building? Do we think we could always keep it full? And are we happy with the cash flow? We always hope to make a profit, but we don't like to overpromise even to ourselves internally, because you can model anything you want in an Excel spreadsheet.
That's right. Yeah, no, some great advice. And I want to get to as well, as we're looking at that, that model, we like it. We've invested. However, now the deal has gone sideways, right? Or, there's some issues happening. I'd love to, your thoughts on, hey, what to do then, right? For that LP, when they're getting that call, right? That, hey, most likely we're losing our money, or maybe it's a capital call.
Sure. Now, well, the question is, what's going wrong? Sometimes like we had some construction projects in the middle of COVID, and it took a lot longer to finish renovations because you couldn't get contractors. People were out sick, or there was a problem with the supply chain. Like I waited a year for 400,000 square feet of roofing for a building. So, and so things like that are understandable. that's a legitimate expense, capital call that's beyond anybody's control, anybody's even thought that something like that could happen. And so you might have to pony up some money, especially if it's for extending an interest rate cap, things like that. But you also should figure out, am I going to get my money out? Don't think, how are you going to make money? Say, are you protecting your existing investment so you get all your equity back? That should be the analysis you're doing, because in some cases you have to spend money to protect all your money to get any of it back, rather than spend none of the money and get nothing back. In a perfect world, if you have a capital call and it's a couple $1,000 and you can make it, and it's for a legitimate reason, like interest rate caps do expire, they shouldn't have expired because sponsors should have taken a longer one to begin with. But you have to really look at the probability of, are you going to get your money back? And I get those calls all the time. And I sat on one call with somebody and they said, "What do you think?" I said, "Well, we don't have a choice because the lender's going to put you in default. We can't refinance. But if we buy the 2-year interest rate cap, I'd like to think in the next 2 years, the Federal Reserve is going to drop rates at least 1.5 points. And at that point, the value should at least come up and we'll get out whole." And the investor said, "Whole?" I said, "Yeah, you should get all your money back." They said, "Okay, we're good if we just get all our money back. That's fine." And I think that's the right way to look at it. Don't say, "What about my profit?" You should assume that something's going to go wrong, and that anyone that promised it's a 25, it's really going to be a 12. And could you live at a 12? Manage your expectations.
I love that question, and managing your expectations. I love that. Because over the last 10 years at least, we've been taught to think, man, just 2x over time, or very quickly, right? And in these big returns, and so we feel like, hey, if we didn't get that, then it's what happened, right? And investors are so upset. But I love the managing your expectations. But I want to manage investor expectations from the sponsor side as well, right? I want to underpromise and overdeliver, instead of them having to cut them in half. What are your thoughts on that?
Well, I guess one thing for an investor to look at a new deal is, does the sponsor have any real equity in the deal? Is it a fund where the sponsor's got no investment in the fund and it's all third-party money? Or is it a deal that's capitalized one at a time and the sponsor might have 15 or 20% of the equity in the deal, which to me would say that he's got a lot of skin in the game. And so I would look at deals like that where the sponsor has a lot of skin in the game, because he's going to protect his money. He's not looking to, that's our number one rule: don't lose money. So, I'm protecting your money as if I'm protecting my own money, because I don't like to lose my own. This is my personal money. Forget the company money too, but I invest in these deals myself. So I'm protecting my money. So that's why we're conservative in what we do. And I think you should really look at, does the investor have any money in the deal? Don't look at the fees as him taking his money out, because there are many deals that die where the sponsor doesn't ask potential investors to contribute for dead deal costs. And so those really just, keep the lights on. They pay for the lawyers, the bank fees, the appraisers on deals that never happen, where you never see an offering on a deal happening. But if the sponsor had, 15, 20, 25% of the equity, great. Or if it's a really large deal, so, let's say it's $100 million deal and the sponsor had $5 million or 5% in, that's still a significant amount of equity on an individual transaction. So I guess it's either percentage or absolute dollar amount, depending on the deal and how many other investors there could be. You want to know sure that the sponsor's not going to say, it's $5 million, it's toilet paper, because nobody's going to say that. I don't care who you are.
What should investors be hearing from sponsors right now? How do you all communicate? What's kind of best in class? Always, but then even right now, anything more than normal?
I think now sponsors should be communicating more often with investors, good, bad, or indifferent. Just to send that we distribute financial statements monthly. Investors get a full set of financials, balance sheet, income statement, general ledger, check register, accounts receivable, and a copy of the bank statement. And a lot of people say to me, "What do I need all this for?" I said, "Because you're an investor. You should have it. I want you to know what's going on at the property. Well, do I have to read it all? I'm like, no, just read the 2-page narrative or the couple of paragraphs at the bottom of the email. That's there as that if you so desire, if this, let's say it's something you don't think is good news and you want to see more detail, all the financial data is there. And we always carry, a trailing 12 forward every month so you can see, comparatively how the property is performing. But I think it's important for people to talk to investors more so. Commercial properties, we have expiring leases. We're talking to people 6 months early. They have a 9-month notice provision, so we're out there 9 months before the lease expires, trying to release the property. And either the tenant wakes up and says, "Oh, I'm going to be homeless," in a commercial tenant, or I'm going to renew, or they're going to find, So you want to know that the sponsor is proactive, and you should tell how your investors how you're being proactive. On multifamily, you should always be updating them monthly. How many renovated, how many unrenovated, how long units are sitting vacant before you can get a tenant in there. What's going on in the market? What's your comparable set you're competing against? And that's something also an investor could look up online at rent.com if they want to see do you think they're really comparables or not? Sometimes those could be for window dressing, sometimes not. Are there any issues at the properties? When does insurance renew? How far advance are you trying to reprice it? You got to show your investors how proactive and hands-on you are. And if there's an issue, have a second email go out in the middle of the month and say, "Hey, we had a problem. We had a fire. Don't let them read it on the see it on the 6 o'clock news or in the newspaper. Tell people real time. Even good or bad. People appreciate your honesty."
That's a great piece of advice there for sponsors. I love seeing, or when there's, especially if it's a good thing, but even if it's an unfortunate thing like that, like taking the opportunity to do what you just said, right? Like, let's go ahead and proactively communicate with them and giving them the information as quickly as possible. I think it says a lot about, your honesty, your integrity, and just wanting to inform them the best you possibly can. What do you say about like what's going to separate, say, the best sponsors from the rest over the next, 12, 24 months as well?
Yeah, that's it. It's going to be an interesting question. I think that there are people that just have a big machine and can always raise money. And I just think investors have to ask the questions on, what did you learn from your mistakes? Or even if you're being honest about your mistakes. I think apartments will always be a desirable class, asset class to invest in, because of their perceived stability. But I think it's about managing the investor returns. Syndicators make money on promote. And I just don't see how that's going to happen as readily or as easily as it has, over the last 10, 12 years in today's market, unless unless everyone's saying, the Federal Reserve over the next 3 years is going to cut rates 300 basis points, and we're going to get cap rates going to go back down to where they were. If I were an investor, I got to think twice about that. You fool me once, shame on me. You fool me twice, shame on me.
Yeah.
That's what I'm saying. Be a little bit more conservative. Apartments will stay full. It's a question on staying power, how well capitalized the deals are, to make sure that they have longevity, to make sure they can continue their occupancy. But again, if you're a new investor, I think you should look at something that's more triple net. A multi-tenant triple net investment. Retail, maybe not, depending on neighborhood shopping center, grocery anchored. Yeah, maybe. There are enough of those out there, but they're hard to finance. But I think there are opportunities, and you just have to be eyes wide open. Where I think a lot of investors who did early syndications made a lot of money and just did a lot less or no due diligence in the last couple of deals, because they say what could go wrong.
No doubt. Yeah, some hard lessons being learned right now. Unfortunately, for a lot of operators in the industry. And so, Irwin, I want to transition to a few final questions. And
Sure.
What's your best source right now for meeting new investors as you all grow your investor base?
We do. I attend a lot of conferences, and some of it's word of mouth. I'm an older American, and I'm not much on this social media stuff. So this is all new to me. We did. I am doing some outreach to through LinkedIn, which people tell me it works. It's interesting. At least I'm getting to get reacquainted with 15,000 people I'm connected to, some of which I haven't spoken to in 10 years, and see what's going on in their world. We are building a funnel to try to, market new investors. And we every once in a while we send out a newsletter to our existing investors. Hey, if we're doing a great job, great. If thank you. Tell us. If you don't want to tell us, tell somebody else that might have an interest. And we always find a couple of new investors on a yearly basis that way. We also have some institutional partners, and we still talk to them. A lot of them are actually back, and they've sort of changed how they look at things. Although that in a fund you're purely IRR driven because that's on your promote. Now it turns out all of a sudden cash flow is equally as important as IRR, which I never heard before. So we talk to a lot of institutional investors as well as high net worths, attorneys, accountants, and we attend a lot of conferences. We'll attend probably more in the next year or so, where you might find more investors than capital allocators, and it's about education. People say to me, "How do you raise equity?" I'm like, "Don't ask for it." And so just like I'm here, I say, I'm not telling you I have a deal I need money for, because I don't even have a deal, but I could find one really fast if I had the money. There are enough deals on the plate, but it's more about trying to educate people and exchanging ideas and telling them what they should look for. If they invest with me, great. If they invest with somebody else, I hope to at least use what I'm trying to teach them to make an investment decision. And that's really the value proposition.
Irwin, what are the most important metrics that you track? It could be personally or professionally.
I tend to track, cash flow on a deal for my investment decision, because, especially if you're a salaried employee, W-2, that's paying your necessities, where cash flow from real estate could buy luxuries. It could buy vacations, and God forbid, let's say you got temporarily laid off, cash flow can help pay your living expenses until you find another job. I never say no to current income. And so that's why we focus primarily on that. We do model for a 5-year hold because everyone likes to see what the potential profit is there. But as long as I know I can continually grow cash flow every year, that's very important. And I'll give you an analogy like that. If your leases are growing at 3% a year, take your body weight, compound your body weight at 3% a year for the next 10 years. Tell me what you weigh. Tell me if you're happy with that weight. Probably not happy with the weight, but think of your money compounding. You're happy with that current return 10 years from now, if knowing that the tenants are paying all the operating expenses. That's how we look at it, and that's why that's equally as important a metric for us as the back end. So 50% of the return, at least 50% should come from current income. The other 50% from appreciation and working the asset.
What are some habits that you have, Irwin, that you're disciplined about that have produced the highest return for you?
We're never the highest bidder on an asset. We bid with what we think makes sense for us. I don't care if the brokers are telling me or the sellers tell me I want to sell it on a 5. If I think it's a 7.5 cap, that's what I offer. You'd be surprised, especially today. There are a lot of sellers really looking to transact. And so now I test the waters. I say, what? I want you to hold a $5 million second mortgage. You'd be surprised. You might get some yeses. Or, what? It's $15 million of equity. We typically raise only 10. I want you to stay in for 5 on the new venture. You might get some interesting responses. So I think if you're a sponsor, be creative. Ask for some of these things. Especially if you have expiring leases coming up and you want them to wrap the leases or provide some kind of fund for the lender to help you finance. Be creative. Ask. You never know. If you don't ask, you don't get.
What's the number one thing that's contributed to your success?
Not overpaying. You got to make your money on the buy. It's all about patience. We have deals that have come back to us, 3 months, 6 months, a year later, because the seller wanted the extra $1 million, or he just didn't find anybody else that was going to meet his price, and all of a sudden he's willing to take less. Because the fund is maturing. Maybe it's the last asset in the fund. We've seen some of those recently too. And people, your reputation is everything. So it's all about relationships in this market. Where once we buy in a certain market, we'd be surprised. People call us. Do you want to buy the building next door, the one down the block, or we see you own? What else do you like to look at? So we're very fortunate in that way, where a lot of deal flow comes to us, whether it's from the big brokerage houses, we might get an early look, or it's a lot of sometimes property owners that own next to us that say, hey, you bought this one. We own the same kind of product. Here's what we want. Let's save the brokerage commission. Can we make a deal?
How do you like to give back?
I like to try to educate people. During COVID, I saw what was going on. I actually, went and I have an educator's license to teach, financial literacy and other financial subjects in the local high school. And I substitute from now and then. It's just interesting that, if 14, 15, 16-year-olds, you try to teach about the banking and investments, how many people have a debit card or a credit card or a bank account, and you get those glassy-eyed kids looking at you, and you try to explain what banking is and saving money and investing. And I really think that that stuff should be started at a much younger age, even basic financial literacy in the elementary school, because I think the sooner that young people understand money and work and investing, the more adjusted they'll be when they get out in the workplace on how to save money and how to budget. So it's not just a surprise. You get your first apartment, you blow your paycheck on whatever, and you got no money to pay rent. I'm sure we've all heard stories like that. So I like to give back. I like to help people with their investments. Even now, I have a lot of calls from investors who have invested in other deals. What do I think they should do? Or even last night, I have a call. Someone said, I was offered a building for 1 million square foot in Stanley, Virginia. I said, it sounds like an old furniture deal. It's been vacant for a few years. They said, how did you know? I said, because typically, I said, I pulled it up on a map while we were on the phone. It's in the middle of nowhere. And that's why the guy's owned it for 10 years and it's empty. I said, he thought he was going to do something with it. Now he just wants to get out.
Wow. Irwin, grateful for your willingness to educate us over the last couple of days as well. So thank you again for your time, even going through in this segment, man, where do investors go wrong, right? And a number of great questions that LPs should be asking sponsors as they begin to do their due diligence and investing and even thinking through when the deal goes sideways, what do we need to do as LPs? What do they need to be thinking about and preserving their capital, right? Ultimately. So thank you again for your time and willingness, your generosity with sharing with us over a couple of days here. Irwin, how can the listeners get in touch with you and learn more about you?
No, my pleasure. You could, it's Irwin at heritagecapitalgroup.net. You can put my name in the search bar, Google. You can go to the website. We just finished doing that. There's also a lot of educational material that we've posted on there, just about cap rates, cash flow, due diligence, things like that might give you some better insight to how to make your own investment decisions, depending what you want. There's also a way to sign up and get on the waiting list for when we do have an investment opportunity, if you want that to be sent to you as well.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.